And that's your homework assignment, to apply that in the context of BASF. I'll show you some data, some evidence on this. Maybe let's have a look at the data directly on the next slide. So we have a very long run dividend history from 2000. I've updated it to 2021. That's fiscal years. So the dividend for the fiscal year 2021 is paid in March 2022, roughly when the General Assembly meeting is. Right? So this is the most recent data that we have. So the gray bars give you, in the left scale, give you the dividend payment in euros. Actually quite curious to see how this looks next year. Actually, BASF is quite depending on the energy business. They have a subsidiary called Wintershall, which is a gas trading company. And it's probably in similar problems as Uniper. Right? So that business might not go so well at the moment. So what we see here is that the dividends had a huge uptake in the years 2004 till 2007, 2008, just until the financial crisis. And the reason was exactly the commodity business I was talking about. The oil prices, gas prices were going up. This was a commodity boom fueled by China. China was importing quite a lot of commodities. Right, so it's the first time the oil price went over $100 was here, I think, in 2006, 2007. And BASF was on a kind of was a company that benefited a lot from that. Then 2009, as part of the as effect of the recession that came after the big financial crisis, they had to reduce the dividend a little bit. Companies are usually hesitant to do that. But then, since that, they've kind of catched up and maintained a pretty stable trajectory. It's actually quite remarkable if you look at this. This is like almost a straight line here, right? It's a very, very stable trend. The corona pandemic, they kept it constant, right? So even in these days, they did not suffer from that problem. So I have the information here on the next slide. So the last dividend they paid was 3.5 euros. Yeah, that should make sense from the picture. And that was paid, that's the last dividend, right? So remember, you have to use the next dividend in the model. So you have to already think about, okay, how do I extrapolate that to the next dividend? So that's the first thing. So you can start basically this is really, there's no 100% right or wrong here. This is really about which numbers would you pick, how would you estimate these things, like what are the choices that you have. And I would like you to think about them a little bit at home and kind of make your own call. And then we can compare our different results and see next week what I would do probably and compare that to what you have done. Right, so first thing is you have to think about, okay, how does this continue? Sometimes maybe you can dig out analyst forecasts for the next dividends, so they are estimating this. Just throw it in Google and see if you can find something. Second thing would be the long-term growth rate. Now, I've given you two numbers from this. The long-term, so for the full 21-year period, the growth rate of the dividends was 9% historically. However, the last 10 years, it was much flatter, right? So the last 10 years, we had only 3.1% per year. Right, so I've kind of did the math for you. If you start here to here, the geometric average will be 9%. If you start here, the last 10 years, it's only 3%, right? So the question is, which choice do you make? Which do you think is more appropriate? You could also kind of do some research. Maybe the managers of BASF have put something in the annual report. What do they expect for a growth rate? What do analysts expect, right? Play around with the numbers, see how sensitive the result is. Try out 3% and 9% and see what kind of range of share prices you get, right? It's kind of a choice that the person who does the valuation has to make. Finally, the last part is the discount rate. And at this point, we haven't studied the capital asset pricing model. That would be one way of nailing down the discount rate. But I want to go back to this formula here because you can actually use the model itself to get a first idea about this. Because if you kind of rewrite this equation, just solve it for the discount rate. You get the following expression. The first expression is the dividend divided by the share price plus the growth rate. So the sum of growth rate and this first term here should give you in the model a consistent discount rate. So the first part here has a special name. Has someone seen this before? What is it? Dividend divided by share price? It's a dividend expressed in percent. It's the so-called dividend yield. Right? So your discount rate is the dividend yield plus the growth rate. And of course, forward-looking. But again, you can do backward-looking computations and look at what was the dividend yield of BASF in the past. And this is actually here in the graph as well. That's the red line here. So this is taken from the annual report. So what they do is they take the dividend payment and divide it by the last share price of the year. It's not quite kind of consistent because, as I mentioned, the dividend is paid with a little bit of a delay. So dividend fiscal year 21 is paid in March. Right, so, but for this last number here, what they did is they took the 3.4 euros, which was paid in March 22, and divided by the last share price of the year 21. Right? And that's their dividend yield. Right? What you will see here is, so every year here is kind of a different share price, basically, behind that. What you will see is, it's the right scale here in percent. You see, it's a pretty stable curve here, right? It's rather flat. The long-term average of this number here is 4.1%. It's the long-term average dividend yield. Just to put this in perspective, it's pretty high. So BASF is a high dividend stock. I think the average for the German stock market or the European stock market might be something around 3.5% dividend yield. That's kind of what people use in models. It's a little bit higher recently. Right? So here we have a little bit higher numbers, around 5%-ish. Again, you have to make a decision. Do you use the long-term average? Do you go with analyst forecasts? What do you think is realistic? Maybe as a side note, there's this outlier here, especially in the year of the financial crisis. How did that happen? Well, we actually see that the dividend did not change in that year, right? So how did this happen? How did the high dividend yield of 7% come together? Well, you divide by the share price. Right? So in this year, what happened to share prices? They went down, right? So you're dividing by a smaller number, right? Because the share price went down, the dividend yield went up. Right? Again, inverse relationship. So in that year, it looked like giving you a pretty decent return only from the dividend of already 7%, right? It's actually a pretty common strategy in the stock markets that people pick out companies with high dividend yield because this would be kind of your regular annual payment that you get, right, if they can maintain the dividend. So you can try to kind of use the formula that we have here, dividend yield plus growth rate. So again, the parameters change slightly that you have to estimate. You have to estimate the next dividend, the growth rate, and the dividend yield. But it's three parameters that you kind of have to nail down. And then all the averages are on here. And then you can apply the formula and compute a share price. What you could also do is, and what we definitely do next week, is compare the share price that we computed here to the actual share price of BASF. So these are real numbers, right? So you can actually check how close you are to the actual share price. And you can play a little bit around with the numbers. So try out different scenarios. How sensitive is the result to a change in one of the parameters? Or if you want, do the reverse computation. Like, what is the growth rate that explains the current share price? Right? So what is the expected growth rate by investors at the moment? Right? You can back that out of this model. So let's put this down homework here. And then there's basically only one page missing that we skipped. All right, so that's just an extension of the perpetuity model, which is the annuity. Again, a special stream of cash flows, and a little example here. But we're going to solve that next week together. And that wraps up already the chapter on the brief review of the present value approach. Do we have any questions, remarks? Again, if I went too fast, let me know. Happy to add more examples in terms of practice problems if you think that you need more practice around this. Okay, so you have your homework, then let's call it a day. And